In this short video, we're going to talk a little bit about the basics of exchange rates. What are they? And how do they impact the relative prices between imports and exports? So we're going to define exchange rates, and we'll look at a simple example about how relative prices change when exchange rates between two countries changes as well. So an exchange rate is really a price. It's another type of price. Specifically, it's the price of one country's currency in the terms of another currency. If we exchange one type of currency for another, what rate does the exchange take place? That's the exchange rate. And we care about exchange rates because they're going to impact the relative prices of imports and exports. And they're also going to impact the attractiveness of domestic and foreign assets. So, for example, the demand for assets in the United States, such as United States Treasury bonds or company stock selling in the United States, one of those factors is going to be the exchange rate between the United States dollar and other currencies around the world. There are two ways that we quote exchange rates, and it depends on the specific currencies we're talking about. So, one way is the foreign currency per one US dollar. And a lot of our major trading partners are quoted this way. So this is used to quote the Japanese yen, the Chinese yuan, the South Korean won, and the Canadian dollar. So with all of these currencies, when we look at an exchange rate, it's the foreign currency, Canadian currency, per one US dollar. Here's an example of a time series of Canada dollar relative to the United States dollar. So this graph is plotting how many Canadian dollars exchange for one US dollar. And we can see in this time series here that there's actually quite a bit of variation. You can see at one point here in 2001, one US dollar could buy $1.60 Canadian. But we actually see in more recent history, it's been very close to parity in terms of one-for-one exchange between a Canadian and a US dollar. So really over this time period of 30 years or so, 30, 40 years, there can be dramatic changes in how this currency is going to exchange. Another way that exchange rates are quoted with other currencies is US dollar per one unit of foreign currency. That's exactly the opposite. And that's commonly used to quote exchange rates between the euro and the US dollar and between the British pound sterling and the US dollar. Again, these differences arise because usually we want in an exchange rate that numerator to be greater than 1. And so it really depends on whether or not a currency exchanges for more than one US dollar in terms of how we quote it. So here's an exchange rate between the United States dollar relative to 1 euro. So again, 1 euro buys how many US dollars? It's always important to look and see how the exchange rate is being measured here. So here we can see 1 euro buys more US dollars here than it did, say, down here. And so that reflects an exchange rate movement. What we see here is that 1 euro steadily bought more and more US dollars during the first decade of the 21st century. And we kind of see it fluctuating around a little bit in the more recent history right there. So when we look at exchange rate movements, we're going to look at it from the perspective of the United States dollar here. So in US dollar depreciation means that 1 US dollar buys less foreign currency. So when 1 US dollar buys fewer and fewer Canadian dollars, we say that the US dollar is depreciating. Another way to say that is the US dollar has fallen, the US dollar is weaker, the US dollar is depreciating. Those are three ways that you're saying the exact same thing. So for example, if we look at exchange rate data from 2000 to 2008, you would actually see for most major trading partners, the US dollar depreciated substantially. 1 US dollar buying fewer and fewer currency. It was true of Canadian dollar, the yen, the euro, the British pound sterling, a lot of our major trading partners. On the opposite end, US dollar appreciation refers to situations where a US dollar is buying more foreign currency. And again, we say that alternatively that the US dollar has risen or that the US dollar is stronger. Again, that, all three things, appreciation, rising, strength, are all saying the same thing. From 2008 to 2009, during the Great Recession, we actually observed that the US dollar appreciated against most major currencies. So during that time period, 1 US dollar bought more and more of major currencies. Let's do an example, specific numerical example, to illustrate exchange rate changes and their effect on relative prices. So we looked at the US and Japan, so we're looking at the dollar and the yen. And suppose we're looking at two products. We have a Ford Fusion for the US product and the Toyota Prius, the Japanese product. Now a Prius costs 2.4 million yen in Japan, and the Ford Fusion costs $23,000 in the United States. And we're going to look at what happens to relative prices of these vehicles under two different exchange rates. So case one, I'm going to have an exchange rate that is 100 yen per $1. Under that exchange rate, I can convert the Fusion price to yen, and I can convert the Prius price to US dollars. So the price of a Prius in the United States, using this exchange rate of $1 for every 100 yen, is $24,000. So we can compare the $24,000 price of a Prius to the $23,000 price of a Ford Focus. If we looked at it from the perspective of Japan, we use the same exchange rate, 100 yen per dollar, and 2.3 million yen would be the price of the Ford Fusion in Japan. This all depends on the exchange rate. So now let's consider a new exchange rate and what are the implications. Suppose the exchange rate moves and it's now 75 yen per dollar. So $1 buys 75 yen. Dollar buying fewer yen, what does that mean? It means depreciation. The dollar has fallen, the dollar is weaker. Alternatively, when we look at it from the view of the yen, that means the yen has risen and that the yen is stronger because it doesn't take as many yen to buy $1. So now let's recalculate the price. So at 2.4 million yen with this new exchange rate, notice that the price of the Prius in the United States would be $32,000. Because of the exchange rate depreciation, the imported Prius got a lot more expensive to people in the United States. At the same time, if we look at conditions in Japan, that Ford Fusion, under this new exchange rate, falls below 2 million yen. So our export to Japan, the United States export of a Ford Fusion to Japan, just got more competitive. It's relatively a bargain to the Prius. So in this example, the dollar fell. It makes the Prius more expensive in the United States. It makes the Ford Fusion cheaper in Japan. And so what happens? Well, probably in the United States, there are going to be fewer Priuses, and people are going to favor the cheaper Fusion. And because of that, when the US dollar falls, what we see is imports are more expensive. Our exports are cheaper abroad. They become more competitive. And in general, a depreciating dollar would cause a trade deficit to fall. Opposite, when the US dollar rises in the opposite direction, imports become cheaper here when our dollar is stronger. Exports are more expensive. It becomes harder for US manufacturers to sell their products in other countries, and the trade deficit will rise. So what does this tell us? Well, so the currency values are really like a seesaw. Remember, if the dollar is rising, the yen has to be falling. Similarly, if the dollar is falling, the yen has to be rising. When we're comparing the two, those arrows have to go in the opposite direction. But what it tells us when we look at the US dollar falling or rising, an exchange rate movement has winners and losers. So if you look at the United States and say, well, is a falling US dollar good or bad? It's not that simple. Because if the US dollar falls, that helps US exports. Farmers, Boeing selling their aircraft abroad, a weaker dollar, a depreciated dollar, makes their products more competitive in other countries. However, in the United States, it can hurt import-related jobs. So people who work at the Toyota dealership, people who work with other imports, they can be hurt because imports are more expensive. When U.S. tourists go abroad, a falling dollar is bad news. U.S. tourists in Europe, the dollar's falling relative to the euro, things are going to be a lot more expensive for them in Europe. But at the same time, if you run a tourism industry in the United States, a weaker dollar is attracting tourists from abroad, and that would help your business. So notice in the United States, we can identify groups that are both hurt and helped by any exchange rate movement.